Does all of the money printing from the Federal Reserve, is that creating greater income inequality? Now, Federal Reserve Chairman has been called to task on this a couple of times. He continues to deny it. But there's an economist from over 250 years ago who says otherwise. I got that and more coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Cohorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. With all of the Federal Reserve stimulus, the money printing that's been happening now for well over a decade, almost 12 years, what are the potential consequences of that? Many people wonder about inflation. I wonder about that as well, although technology is deflationary and we are in the tech revolution. So I have my suspicions on whether we'll see rampant inflation. But there is a question as to whether all of the Federal Reserve stimulus and monetary policy is actually creating more divide in those that, are the upper middle class, the top 10%, the top 1%, the top 0.1%, and those in the lower middle class and even the lower class. That divide has definitely been widening, especially during COVID. There's no question about it. It seems as though COVID has made winners and has unfortunately made losers financially. And is it possible that the economic policy, the monetary policy by our Federal Reserve has actually been contributing to this separation, this divide, this gap, widening gap in socioeconomic status? And now, Federal Reserve Chairman Jerome Powell has been asked this question several times. In my opinion, he's dodged it. He's just flat out denied it or spoken defensively. He hasn't really addressed it. And you might say, well, it's probably a new idea. Maybe he hasn't thought about it. Guys, 250 years ago, an Irish-French economist named Richard Cantillon, and I don't know if it's Cantillon or Cantillon, I have no idea exactly how to pronounce it, but he basically came up with this theory that the more money printing and manipulation, accommodation that central banks do, it's going to create a bigger divide in the status or the socioeconomic status of its citizens. Very, very interesting. So read up more on Richard Cantillon, but essentially the Cantillon effect, his namesake thesis, I think he wrote about in his essay in the 1730, but it really didn't become popular until after he died, 1755, and then now it's sort of the gospel of political economic thinking. And so basically what he said is when the Federal Reserve or when a central bank goes to inject money into its economy, they tend to do so, or at least claim to do so, out of just and noble purposes. We're trying to prop people up. In fact, even right now with this $1.9 trillion stimulus that politicians are talking about, they want it to go to help those in need, right? But it's not, when they print this money, when they inject this money, it's not like water being poured over an ice cube tray that very quickly goes and spreads evenly throughout all of the areas. It's more like honey being poured on that ice cube tray, where it will concentrate in one area, be very slow moving. It will eventually, given enough time, it will eventually flatten out, okay? But it will do so disproportionately. It will take a lot of time. And it will concentrate in one area. Here's his thesis. Tell me if this sounds familiar. That instantly, when central banks print money, instantly asset prices will go up, almost instantly. And he said sometimes seconds, sometimes minutes, it's almost instantaneous. You will see asset prices rise, stock prices, home prices. Yeah, we actually saw that. So if you own stocks or you own your own house, you appreciated, you actually won a little bit from some of this stimulus. If you haven't been an investor and don't own a house, those in the lower middle class or the lower class, you didn't have that win. So the Cantillon effect says instantly asset prices will get bid up, okay? Second, businesses who have the least friction in their operations will be able to quickly deploy the new capital or the new accommodative financial conditions, or borrow at much lower rates and turn it around and make a profit on those dollars. Businesses with the least amount of friction will be able to capitalize next, also extremely quick. Tech companies have the least amount of friction, the least amount of overhead, the least amount of manufacturing. They're the ones that, and we saw this over the past year, they were the ones that were instantly able to exploit, and we're still seeing it, able to exploit these accommodative financial conditions. Next, it will transpire to other businesses or translate to other businesses where they will begin raising their prices as well as they are taking advantage of these looser economic conditions. And then eventually, the money printing will make its way all across to everyone else, and low wage earners who have already had to deal with higher prices, higher cost to buy a house, higher cost to buy stocks, higher cost to maybe buy technology or buy other goods and services, because those entities have already taken advantage of these accommodative financial conditions. Then it's folks at the lower wage earners finally start to see their wages go up. Finally, after long periods of time, but it's not until after they've already had to grapple with higher prices. Richard Cantillon, the Cantillon Effects, actually says that federal stimulus and central bank monetary policy actually creates more polarizing, a greater divide in socioeconomic status, despite the claims of politicians or even the Federal Reserve of saying we're injecting the money to help those who actually need it. No, it's actually going to help the financial economy before it helps the real economy. So, what do you do about it? Number one, I would just have an awareness, because I fear that the central bank injecting of money could be a more permanent feature than any of us would have expected. I mean, guys, let's be honest. It's been around since 2008. They never got out of. They never took the economy off life support. They've just continued to have accommodative financial conditions. The only time they really tried to take a meaningful step out was in the fall of 2018, and the stock market did not like it. They quickly reversed course. And now here we can see in 2020 and 2021 how financially things appear to be very much just fine, but the economy, we all know, is really struggling, still on life support. So I fear that this could be a more permanent feature, the Fed injecting money and doing accommodative financial conditions, monetary conditions. So we could see this divide expand even more to possibly some sort of tipping point, if you will. But I certainly can't see the future. So that's one, just be aware. Number two, own assets. Own assets. So as scary as the stock market can be at times, own assets. If you're able to own your own house, if that makes sense, given all 6 areas of your financial life, I would do so. I would do so. But third, I would make sure that for your entire financial life, you're taking prudent steps. Don't get overextended on risk, because if the economy, if it does get to the point where the Fed finally says, nope, we've got to step out of this, there could be some serious repercussions in the stock market, like we saw in the fall of 2018. But if that doesn't happen and the Fed is here to stay for good, that's going to lead to other potential, if the Cantillon effect is accurate, lead to other potential consequences. So make sure your financial house is in order and you've got stability. You're taking wise steps with having a prudent budget and cash flow system and emergency fund, not getting yourself overextended on debt, making sure that you're investing wisely with wise strategies. Work with your CFP on that. If you don't have a CFP on your team, you can always contact one on my team. Find us online, wisemoneyshow.com or corehorn.com. That's Corehorn with a K, or send us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.